$1.8 trillion, that's not the national debt. That's not the federal budget. That's how much money hedge funds have bet on a single trade in the United States Treasury market right now. And here's what makes that number terrifying. They're doing it with leverage ratios of 50 to 1. Some funds are running at 100 to 1. That means for every single dollar of their own money, they've borrowed between $50 and $100 to place this bet. In April of 2025, this trade almost collapsed. The Federal Reserve held emergency meetings. Major financial institutions were called in. And nobody told you. Not a single headline. Not one evening news segment. Nothing. By the end of this video, you're going to understand exactly what this trade is, why the smartest money on Wall Street is quietly repositioning, and what happens to your savings, your retirement, and your purchasing power when this thing finally unwinds. Because it's not a question of if. The pattern has played out before. 3 times. Same setup, same leverage, same ending. Every single time. Let's start with the basics, because this is something Wall Street doesn't want you to understand. The Treasury market is the foundation of the entire global financial system. When the United States government needs to borrow money, it issues Treasury bonds. These are considered the safest assets on Earth. The bedrock. The risk-free rate that everything else is measured against, your mortgage rate, your car loan, corporate bonds, foreign government debt, all of it is priced relative to US Treasuries. Now here's where it gets interesting. There are 2 ways to get exposure to Treasury bonds. You can buy the actual bond in what's called the cash market, or you can buy a futures contract, which is essentially a promise to buy that bond at a specific price on a future date. In theory, these 2 prices should be almost identical. The cash bond and the futures contract are economically the same thing. But in practice, there are tiny differences. Sometimes the futures contract trades slightly higher than the cash bond, sometimes slightly lower. The difference is called the basis, and that difference, that tiny gap, is where hedge funds saw an opportunity. The trade works like this. A hedge fund buys Treasury bonds in the cash market and simultaneously sells futures contracts on those same bonds. They're betting that the prices will converge as the futures contract approaches its delivery date. When they do, the hedge fund pockets the difference. Now you might be thinking, how much money can you really make on a tiny price discrepancy? And that's exactly the right question. The answer is not much, unless you use leverage. So here's what these funds do. They buy Treasury bonds. Then they take those bonds to a bank and use them as collateral for a loan through something called the repo market. Repo stands for repurchase agreement. The fund sells the bonds to the bank with an agreement to buy them back the next day at a slightly higher price. That difference is essentially the interest rate on an overnight loan. The fund takes the cash from that repo loan and buys more Treasury bonds. Then they repo those bonds for another loan. Then they buy more bonds. And they repeat this process over and over until they've built a position that's 50, 60, sometimes 100 times larger than their actual capital. For every dollar they started with, they now control $50 to $100 worth of Treasury bonds, all financed with overnight loans that roll over every single day. When it works, it's free money. The spread between the cash bond and the futures contract is small, but multiply it by 100, and suddenly you're generating enormous returns on what appears to be a risk-free trade. The bonds are backed by the full faith and credit of the United States government. What could possibly go wrong? Everything. Everything can go wrong. And it has. 3 times. Let me show you the pattern. The first time this exact trade blew up was 1998. A hedge fund called Long-Term Capital Management had assembled the most impressive collection of financial talent ever seen. 2 Nobel Prize winners in economics on their board, the former vice chairman of the Federal Reserve, traders from the most elite institutions on Wall Street. They were considered geniuses, untouchable. LTCM ran the basis trade among other relative value strategies. They used enormous leverage, around 25 to 1 on their balance sheet, but their true economic leverage through derivatives was much higher. At their peak, they controlled over $125 billion in assets with only about $5 billion in actual capital. Then Russia defaulted on its debt. It had nothing to do with US Treasuries directly, but it didn't matter. When markets panic, correlations go to 1. Everything moves together. Spreads that were supposed to converge started diverging instead. LTCM's positions, which were supposed to be market neutral, started hemorrhaging money. The losses triggered margin calls. The fund had to post more collateral, but they didn't have the cash, so they had to sell positions. But when you're that big, your selling moves the market against you, which triggers more losses, which triggers more margin calls, which forces more selling. In a matter of weeks, LTCM lost nearly $5 billion, their entire capital base. The fund was on the verge of collapse, and the Federal Reserve determined that if LTCM went down, it would take the entire financial system with it. The Fed organized a bailout. 14 major banks put up $3.6 billion to prevent a systemic meltdown. The fund was liquidated in an orderly fashion. The financial system survived. But here's what nobody learned from that episode. The trade didn't go away, the leverage didn't go away, the risk didn't go away. It just moved. It got bigger, and it waited. Check. The second time was March 2020. The COVID pandemic hit, and markets went into freefall. Stocks crashed. But something strange happened in the Treasury market. Normally when there's a crisis, money flows into Treasuries. They're the safe haven, the flight to quality. Prices should go up and yields should go down. Instead, Treasury prices crashed and yields spiked. The safest asset in the world was selling off in the middle of a panic. It made no sense, unless you understood the basis trade. Hedge funds running this trade had built up massive positions. When the market dislocated, their positions started losing money. Banks that were financing these trades through the repo market started demanding more collateral. Haircuts on repo loans increased. Some banks stopped lending altogether. The hedge funds faced the same doom loop as LTCM, margin calls, forced selling, prices moving against them, more margin calls, more forced selling. In a matter of days, hedge funds were forced to unwind $90 billion of basis trade positions, $90 billion, and they were selling into a market that had no buyers. The Treasury market, the deepest and most liquid market in the world, was seizing up. The Federal Reserve had to intervene. They bought $1.6 trillion of Treasury bonds in a single month. $1.6 trillion. To put that in perspective, that's more than the entire GDP of South Korea, purchased in 30 days. Just to keep the Treasury market functioning, the financial system survived. Again. But here's the part that should terrify you. The Federal Reserve's intervention didn't just save the market, it saved the hedge funds running the basis trade. The Fed effectively bailed out a leveraged speculation in the Treasury market. And what message did that send? What do you think happened next? The trade got bigger. Much bigger. Check. The third time was September 2019. 6 months before COVID, most people have completely forgotten about it. The repo market, the overnight funding market that finances the basis trade, suddenly froze. Interest rates on overnight loans spiked from around 2% to 10% in a matter of hours. Some trades were reportedly done at double-digit rates. Banks that should have been lending into this market simply stopped. There wasn't enough liquidity. The Federal Reserve had to inject $75 billion in a single day to stabilize the market. They continued emergency operations for months. At the time, nobody could fully explain what happened. The official story involved corporate tax payments and Treasury settlement dates. Technical factors, nothing to worry about. But the underlying truth was simpler. The basis trade had grown so large and the leverage so extreme that the system could no longer handle it. There wasn't enough balance sheet capacity at the major banks to intermediate all the repo lending that the trade required. The plumbing was overwhelmed. The Fed patched it with emergency liquidity. The trade continued. The leverage continued. The risk continued to build. Check. 3 examples. Same pattern, same leverage, same ending. A bailout by the Federal Reserve and a trade that comes back bigger than before. Now let me tell you where we are today. As of late 2025, hedge fund exposure to the Treasury market stands at $1.8 trillion long and $1.4 trillion short, close to record highs. The net short futures positioning of hedge funds, which is the best proxy for the size of the basis trade, exceeds $800 billion. This is larger than it was before the COVID crash, larger than it was before the 2019 Repo Crisis, larger than LTCM ever dreamed of. The leverage ratios are the same, 50 to 1, 100 to 1. Every dollar of hedge fund capital supporting $50 to $100 of Treasury positions, financed by overnight loans that have to be rolled every single day. And here's what happened in April 2025. President Trump announced a sweeping tariff policy on April 2nd. Markets went into turmoil, stocks crashed. But look at what happened to Treasuries. Instead of rallying as the safe haven, Treasury yields spiked. The 10-year yield surged past 4.5%. The 30-year yield broke above 5%, the steepest rise since 1981. Bonds and stocks were selling off together, just like March 2020, just like 1998. Hedge funds running the basis trade started getting margin calls. Banks financing the trade started demanding more collateral. Some funds had to liquidate positions to meet the calls. The selling pressure intensified. The Financial Times reported that major basis desks shed roughly 10% of their gross notional exposure in just 3 trading sessions. 10% of a $1 trillion trade unwinding in 72 hours. Nick Lawson, the chief executive of Ocean Wall, told the Financial Times, quote, "As things spiral, they're being forced to sell anything they can, even good assets, just to stay afloat. If the Federal Reserve doesn't step in soon, this could turn into a full-blown crisis. It's that serious," end quote. The Federal Reserve didn't have to step in that time. The tariff policy was partially reversed. Markets stabilized. The margin calls stopped. But here's what you need to understand. The trade didn't unwind. The leverage didn't come down. The hedge funds used the breathing room to reload their positions. Within weeks, the trade was back to its previous size. The bomb didn't explode, it just reset the timer, and then in November 2025, something happened that barely made the news. The head of the New York Federal Reserve called in the major financial institutions for an unscheduled meeting. The stated reason was spikes in the standing repo facility, the Fed's money market backstop. But the unspoken concern, according to Bloomberg, was leverage, specifically borrowing by hedge funds. The Financial Stability Board issued a report in July 2025 warning that hedge fund leverage poses systemic risk. They noted that in the UK alone, 7 hedge funds account for 90% of all repo borrowing, and that figure is at its highest level since data collection began in 2016. The smart money knows. The regulators know. The Federal Reserve knows. They're holding meetings. They're issuing warnings. They're preparing, and they're not telling you. Let me be very clear about what stage we're in. This is stage 3. The silent repositioning, the insider preparation, the same stage that preceded every collapse. In stage 1, the trade grows. Success breeds confidence. Leverage increases. The returns look like free money. Everyone piles in. In stage 2, the system becomes overextended. The leverage reaches levels that the infrastructure can't support. Warning signs appear but are dismissed. This time is different, they say. We have better technology, better risk management. The Fed has our back. In stage 3, the smart money starts to quietly reposition. Not in a panic, not publicly, just a gradual reduction in exposure. A whisper network among the institutions. Emergency meetings that don't make the news. The public is told everything is fine. Stage 4 is the collapse, a trigger event, margin calls, forced liquidation, a doom loop that feeds on itself until the central bank has to step in with trillions of dollars to prevent systemic failure. We are in stage 3. The evidence is everywhere if you know where to look. The Federal Reserve published a research note in October 2025 examining the cross-border nature of the basis trade. They found that hedge funds domiciled in the Cayman Islands hold approximately $1.4 trillion more in Treasury positions than official data shows. The actual size of this trade is even larger than the public numbers suggest. The Dallas Federal Reserve published an analysis in July 2025 examining how sensitive the basis trade is to funding conditions. Their conclusion was that the trade is considerably more sensitive to declines in intermediation capacity than to funding rate increases. In plain English, if banks stop lending into the repo market, this trade unwinds violently. And in a crisis, banks always stop lending. Treasury Secretary Scott Bessent has publicly stated that leverage ratio reform is necessary and that bank regulators are working on proposals. Why would the Treasury Secretary be talking about leverage ratios if there wasn't a problem? The pieces are all there. The question is whether you're paying attention. Now, I know what some of you are thinking. This time is different. The Federal Reserve has tools now that it didn't have before. The standing repo facility, currency swap lines, emergency lending authorities. If the trade starts to unwind, the Fed will just step in like they did in 2020. And you're right, they probably will. But that's not the point. The question isn't whether the Fed can prevent a financial system collapse. The question is what it costs to prevent that collapse, and who pays. In March 2020, the Federal Reserve expanded its balance sheet by $1.6 trillion in a single month. They bought treasuries, mortgage-backed securities, corporate bonds. They became the buyer of last resort for the entire financial system. When the Fed buys assets, they pay for them by creating bank reserves. New money entered into the system with a few keystrokes. This is what people mean when they talk about money printing. Now, in the short term, that money printing prevented a depression. It stabilized markets. It allowed the economy to function, but it wasn't free. All that new money eventually works its way through the system. Asset prices inflate. Consumer prices follow. The purchasing power of every dollar you hold declines. The inflation you experienced in 2021, 2022, 2023, that wasn't an accident. That was the cost of the 2020 bailout working through the system. The hedge funds got saved, you got higher prices, and the next bailout will be bigger. Because the trade is bigger, because the leverage is higher, because the Fed has taught the market that there's always a put option. If things go wrong, the central bank will print whatever is necessary to prevent collapse. The financial term for this is moral hazard. When you remove the consequences of risk-taking, you get more risk-taking. When you bail out leverage, you get more leverage. The Fed's own interventions have created the conditions for a larger crisis. This is the doom loop that nobody talks about, not the doom loop of margin calls and forced selling, although that's real too. The doom loop of bailouts and money printing, crisis, intervention, more risk-taking, bigger crisis, bigger intervention, even more risk-taking. Each turn of the cycle, the numbers get larger. Each turn of the cycle, your dollars buy less. Each turn of the cycle, wealth transfers from those who hold currency to those who hold assets, from savers to speculators, from Main Street to Wall Street. The pattern doesn't care about your politics. It doesn't care about your hopes. It doesn't care that you've worked your whole life and saved responsibly. The pattern just executes. Let me tell you what stage 4 looks like when it arrives, a trigger event. It could be anything: a geopolitical shock, a policy mistake, a major hedge fund blowing up, a foreign central bank selling treasuries. The specific cause doesn't matter. What matters is that it creates volatility in the treasury market. When volatility spikes, the futures exchange increases margin requirements. Hedge funds that were meeting their margin with a thin cushion suddenly need to post more cash. Many of them don't have it. They're fully invested, every dollar leveraged to the maximum. They go to the repo market to borrow more cash. But the banks are scared now too. They see the volatility. They know these hedge funds are leveraged 50 to 1. They start demanding higher haircuts on the collateral. Some banks stop lending entirely. The hedge funds have to sell, but everyone is selling. There are no buyers. Prices gap down, which triggers more margin calls, which forces more selling. The treasury market, the deepest and most liquid market in the world, starts to seize up. Bid-ask spreads blow out. Price discovery breaks down. Trades that should settle in seconds take hours. And here's where it gets truly dangerous. The treasury market isn't just any market. It's the collateral that backs everything else. Banks use treasuries as collateral for interbank lending. Money market funds hold treasuries as their primary asset. Pension funds, insurance companies, foreign central banks, all of them hold trillions in treasury securities. When treasury prices crash, all that collateral is suddenly worth less. Margin calls cascade through the entire financial system. Banks that were solvent in the morning are undercapitalized by the afternoon. Credit markets freeze. Commercial paper stops rolling. Companies can't make payroll. The Federal Reserve sees this unfolding, and they have a choice. Let the system crash and deal with a depression that makes 2008 look like a mild recession. Or print. Print trillions. Buy everything. Become the market. They will choose to print. They always choose to print. And when they do, the money you've saved loses purchasing power. The retirement you've planned for buys less. The wages you earn fall behind. The assets you don't own become even more unaffordable. That's the real cost of the basis trade, not to the hedge funds. They'll get bailed out. They always get bailed out. The cost is to you, to everyone who holds dollars instead of assets, to everyone who believed the system was stable. So what do you do with this information? First, understand that you cannot time this. I'm not telling you to sell everything tomorrow and move to cash. Cash is exactly what loses value when the Fed prints. I'm telling you to think about your exposure, your concentration, your assumptions about what's risk-free. The treasury market is supposed to be risk-free. It's not. It's a casino where hedge funds bet with 100 to 1 leverage and the Fed backstops their losses with your purchasing power. That's not risk-free. That's risk transferred. Second, consider diversification that actually diversifies. Most portfolios have a stock and bond allocation and call that diversified. But in a crisis, stocks and bonds can sell off together. We saw it in April 2025. We saw it in March 2020. The correlations that work in normal times break down when you need them most. Real diversification means assets that don't depend on the same system. Physical assets, commodities, real estate, precious metals, assets that can't be printed by a central bank. Third, reduce your debt. In an inflationary environment, debt can be beneficial because you're paying it back with cheaper dollars. But in a crisis, cash flow is king. If you lose your income, debt payments don't stop. The hedge funds have taught us that leverage is a double-edged sword. Don't be leveraged when the music stops. Fourth, have liquidity. Not all your assets, but enough that you're not a forced seller. The hedge funds blow up because they face margin calls they can't meet. If you can meet your obligations without selling assets at the worst possible time, you survive. Survival is the first goal. Fifth, pay attention. The warning signs are there if you look. Watch the repo market. Watch Treasury auction results. Watch for emergency Fed meetings. Watch for language from regulators about leverage and systemic risk. When the smart money starts repositioning, don't be the last one holding the bag. The pattern has played out 3 times. LTCM in 1998, the Repo Crisis in 2019, the COVID crash in 2020. Each time the Fed intervened. Each time the trade came back bigger. Each time the eventual reckoning was postponed but not prevented. We are now at the largest position sizes in history, the highest leverage in history, the most concentrated risk in history, running on overnight financing that has to roll every single day. The Federal Reserve knows, the Treasury Secretary knows, the Financial Stability Board knows. They're holding emergency meetings and issuing warnings and preparing interventions. The question is whether you know. The smart money is repositioning. The insiders are preparing. The clock is ticking. And the pattern doesn't care what you believe. The pattern doesn't care what you hope. The pattern doesn't care that you've done everything right and played by the rules. The pattern just executes. Same setup, same leverage, same ending, every single time. The only question is whether you're ready. In part 2 of this series, we're going to look at exactly what the Federal Reserve can and cannot do when the next crisis hits, the tools they have, the constraints they face, and why the next intervention might not be as smooth as the last one. Make sure you're subscribed so you don't miss it. And if this video helped you understand something that Wall Street doesn't want you to know, share it with someone who needs to hear it. The first step to protecting yourself is understanding the game you're playing. Now you understand. The clock is ticking.